Welcome back to KI Investing, your edge in investing. Here we talk smart investing, artificial intelligence, and how to build real financial freedom. Today we're diving into one of the most talked about and controversial AI stocks out there, C3.ai. Some people call it pure AI hype. Others believe it could be the next Palantir, or even the Tesla of artificial intelligence. But what's really behind this company? What exactly does C3 do? How do they make money? And is this stock a smart opportunity or a dangerous gamble? Let's break it all down, honestly, clearly, and data-driven. Let's start from the top. What is C3.ai? C3 is a US-based tech company headquartered in Redwood City, California. It was founded in 2009 by Tom Siebel, a real Silicon Valley veteran. He previously founded Siebel Systems, which was acquired by Oracle for nearly $6 billion. C3 develops AI software platforms for large enterprises and government organizations. They help companies analyze huge amounts of data, detect patterns, and make real-time data-driven decisions. Unlike many AI companies focused on chatbots or consumer apps, C3 targets mission-critical industrial applications. Think energy companies, the military, financial institutions, and heavy industry. Here are some real-world clients. The U.S. Air Force uses C3 to predict aircraft maintenance. Shell uses it to optimize refinery operations. Baker Hughes integrates the platform into their energy services. In total, C3 covers over 25 use cases, including fraud detection, supply chain monitoring, energy optimization, and predictive maintenance. The business model is software as a service, SaaS. Clients pay monthly or annual subscription fees based on usage and features. A major shift came in 2023 when C3 switched to a consumption-based pricing model. This significantly lowered the barrier for new clients and made it easier to scale adoption. Now let's talk numbers. Market cap around $3 billion as of May 2025. Revenue last fiscal year, approximately $270 million. Cash reserves over $700 million. Debt, essentially zero. They have a very clean balance sheet. Gross margin, approximately 69%. Loss per share, $0.55. Bottom line, C3 is not a dying company, but it's not profitable yet either. They're spending heavily on growth, marketing, and product development. The stock itself is highly volatile. In 2023, it traded between $10 and $35, a swing of more than 200%. In March 2024, it surged 38% in 5 days and dropped 25% just 2 weeks later. And here's the key. C3 doesn't move only based on its own performance. It moves with the overall AI hype. If investor confidence in AI drops, C3 falls with it, no matter how good their results are. Let's talk about the opportunities, the risks, and my personal take. Opportunity number one, the market. According to Markets and Markets, the global enterprise AI market will grow from $28 billion in 2024 to over $134 billion by 2030. That's an average annual growth rate of around 30%. If C3 can carve out even a small slice of that, it could be massive. Opportunity two, their platform model. C3 doesn't just offer tools, they provide entire platforms. It's like an operating system for enterprise AI. Once you build on it, you tend to stay in the ecosystem. Opportunity three, government contracts. C3 already works with the U.S. Department of Defense, the Air Force, and other federal agencies. These deals can be worth billions and usually run for multiple years. If they win more of these, the revenue potential is enormous. Opportunity four, cloud partnerships. C3 has formed integrations with Google Cloud, AWS, and Microsoft Azure. This opens the door to broad deployment and makes their platform more appealing to big organizations. Opportunity five, lower entry barrier. Thanks to the new usage-based pricing model, even smaller companies can now test C3.ai's platform without a massive investment. That could drive more signups and long-term clients. But of course, there are also risks. Risk one-to-one, profitability. C3 is still not profitable. The last quarter showed a net loss of about $70 million. If growth doesn't accelerate, they may need to raise capital in 2 to 3 years. Risk two, competition. Palantir, Microsoft, IBM, and Amazon are all building in this space. They have bigger teams, more money, and deeper sales channels. C3 was early, but they're no longer alone. Risk three, management. Tom Siebel is experienced, no doubt, but some investors say he tends to overpromise and underdeliver. His communication style is bold, and his guidance is often extremely optimistic. Risk four, stock hype. C3's stock is hype sensitive. When the AI buzz cools off, it tends to fall faster than its peers because its valuation is based mostly on future potential, not current profits. What do analysts say? They're all over the place. Some price targets are at $15, others at $40 or more. As of May 2025, the stock is trading between $21 and $26, right in the middle. The takeaway, no one knows where this is headed. Everything depends on how well C3 executes in 2025. My final take, C3.ai is a bold, high-risk, high-reward stock. The fundamentals are okay. The leadership is strong. The market potential is massive. But the volatility is real, and not everyone can stomach it. If you have a balanced portfolio and want to make a calculated bet, you could consider putting 2 to 4% of your capital into C3- as a potential moonshot play. If C3 executes well, we could see prices hit $50 or even $70 by 2025 to 2026. But if not, it could crash below $10. Simple as that. High upside, high risk. So what do you think? Is C3 a stock you'd invest in, or would you rather stay away? Let me know in the comments. I read every one of them. And if you like this breakdown, make sure to give it a thumbs up, subscribe, and hit the bell so you don't miss future videos. KI Investing, your edge in investing.